Hello, Greg Kuda.
Hey, Mike, how are you?
I'm good. There we go. Got some volume. I'm all good, man. I'm a happy Bears fan today.
Yeah, great game. I'm obviously being an Ohio State fan. I'm a Justin Fields guy, so I thought it was pretty obvious. Run the ball, and they didn't try to reinvent the wheel like my team does in beating teams here. Just run the ball.
Yes.
So they stopped.
Well, I say that in jest because this is my true
Oh, I
fan,
got okay.
but I'm getting a little embarrassed right now.
Yeah,
It's been a tough slug here as a Packers fan. I'm not used to
yeah. No, I think between the Packers and the Buccaneers, it's what's happening, right? What's going on?
exactly. All right. Well, hey, it's noon. Why
Sure.
don't you're gonna have to share your screen here? You forgot to do that. There we go. Um, let's kick this off. October 25th. I guess the first thing I look at is the 31st is Monday. So yeah, when we talk next Tuesday, the front month contract November will be in no limit zone.
Yeah, yeah, and you know what, Mike? I completely forgot to add this slide.
About the new limit.
Yeah, let me see if I can dig that up quickly here.
Yeah, that's. I think that's a good idea. Actually, that's really important
I think
for
that's a
people to
good one.
know.
Let me. I'll pull up. We'll pull up real-time quotes here in the interim, and people can see. We had kind of obviously the big rally Thursday into Friday, and we've given pretty much all of it back now, and kind of go over some of the reasoning behind it, because there certainly doesn't seem to be anything bearish about physical cash now. But the idea of how we talk about basis on and on and on. I think this is a great example. I've got some great slides here on basis, and I found the email, so let me drag this out.
I was just as you said that about putting the slide in there. I know you can subscribe to the
Yeah. Yep.
CME group, and I was just pulling up their website. Those are market regulatory advisor.
Yeah, another little secret here. You can subscribe to Fraser, you can subscribe to Canfor, you can subscribe to Interfor, Resolute, pretty much any company out there that's got an IR investors relations department will subscribe to all their news, the CME, and then you can customize it from there. So you can have Fraser send you their earnings. You can have you'll be the first one to know when they blast it out publicly on curtailments. Like same thing with the CME. This is all stuff that's put out for public dissemination, and everybody should actively subscribe to this.
Yeah, shoot. It's super easy, except I can't figure out how to do it right now. They're called market regulatory.
Yeah, if you click on, you can see it. If you click on this advisory, and obviously you can't do it, but if you just just Google CME market advisories, and then you'll see it's pretty easy. It'll take you to a place where you can sign up for these. You might have to register with the CME. I think you do, but it's just a one-time thing, and then you can customize what kind of advisory notices you get, anywhere from margin increases to price limit changes to new contract changes, rolling out of new contracts, whatever you want to customize it to. It could be all ags. You're looking at interested in energies. The sky's the limit how you can customize what they blast out to you. But so as of, the interesting thing here, as of next Tuesday, we all know that November is the spot month. So there's no contract limit in spot month, legacy or the mini. The big change is going to be for the legacy contract. And again, this would be for January and or March. Either one can trigger limits. So you're going to go from $49 a
Can you
thousand board
can you just
feet.
zoom in a little bit on that possibly?
Let me see if I can do that here.
Well, zoom.
Yeah.
There you go.
Yeah, there you go.
He's got.
Is this too much?
No, let me get back to the.
Here, let
Oh,
me
I
try it
let me
this way.
get the caption out of the way. That'll help. Okay.
Okay.
That's perfect.
Okay. So we're going to go from the existing limit of $49. The new limit effective, again, this would be for January and beyond, as of next Tuesday, is $24. Expanded limits would be $36. So the big difference, and I can't, this is extremely important. The mini contract still has a floating price limit that gets triggered at maximum price limit on any given day with the mini contract is 10%. That's not going to change. So you're going to have instances where the big contract conceivably can get locked limit up or locked limit down at $24 a thousand. The mini contract is still going to have a 10% max limit based upon that underlying contract value from the day before. So what that means, and I kind of tried to use an example here, January Legacy could have a $24 limit and the January mini contract could still trade $61.50 based upon this is from last when this notice came out, I think last Wednesday or Thursday. So you're going to have lots of, the reality is $24 isn't that much of a move to trigger a limit move up or down. You're still going to have these 10% limits in the mini. So you're going to have lots of arbitrage opportunities moving forward between the legacy contract and the mini contract, where the mini is going to float to reality a lot faster versus the legacy contract at $24 a thousand limits.
Yeah. And this is not for a short time period. This is till May 1st.
This is basically for all intensive purposes, this is for the remainder of the legacy contract, because at that point where this would reset, you're not going to have the May contract is the last legacy contract to go off. Thereafter, those contracts thereafter in legacy don't exist. So this is what it's going to look like through the end of time. This is what it's going to look like through the end until you sunset out the legacy contract next quarter, or I'm sorry, next year, 2023. So, the other big thing is because the volatility is dramatically lower and they're reducing these price limits, Alex and I have formally requested CME SPAN, CME margins revisit margin requirements in both the legacy and mini contract for outrights and spreads. So we're trying to get them to lower those margin requirements now in anticipation of this. So I'll get that out of here, and then we can kind of kick off. I just we'll kind of again start. We normally do. I think the big shift week over week is equities have officially bottomed.
You might want to make it full screen there,
Oh,
Greg.
okay. Yep. Slideshow. Okay. Good.
Thank you. Yep, perfect.
Okay, so we've had a nice bounce in equities where we're up anywhere from kind of 3 to 5.5, 6% off of the recent lows from last week in the S&P, the Dow, and the Nasdaq. There's no real significant change in any of the other markets. 10-year is still hanging in that 4% plus area. I showed this chart last week. We talked about all the Elliott Wave guys, and I subscribed to 3 different guys that are heavy Elliott Wave market guys with equities. And they all were forecasting a wave count bottom into the last couple of weeks and kind of generated long signals. So you can see, true to form, this is the S&P 500. You had a nice outside reversal day. So on the charts, what is an outside reversal? You made a lower low, you made a higher high from the previous day. More importantly, you closed above the previous day's high. So this was a phenomenal buy signal in the S&P. You actually made a low this day of about 3640, 3650. And from this low, S&P has gone from 3650 to today's highs of just sub 3870. I think 3868 is the high here so far. Let me pull up my, I just want to look at my,
what is the high? It's 3863.50.
Yeah, 30, here you go, 3863.50. So the objective now, as far as timing versus price, drag that out of the way. So the objective now would be 62% retracement, which is a 39.22 to 40.22. Here's the 100-day moving average. That comes in that 39.25 area. You're trying to break out of the Bollinger Band here. This is the 40-day moving average right here. So you can see from a timing standpoint, your wave count takes you pretty much into the middle of November. I'll call it the week before US Thanksgiving. From a price standpoint, the objective is this, another kind of handle to a handle and a half higher, this 39 to 40 area. Timing versus price, pick one or the other. Don't be greedy and look for both. So, to me, this is a great dead cat bear market bounce here, and it's all being fueled off of better than expected earnings, even with dumbed down forecasts. Life is good when you look at Q3 earnings, and again, you can run through the woods with your eyes closed and not see the boogeyman, and that's what the market's trying to do right now.
Well,
that's my opinion.
That we need to really, I look at the stock market is a forward-looking indicator.
Yep.
People, you don't buy stocks today because you think they're going to sit still. So really, the market prices in where we think it can go.
Sure.
So, if we are bouncing here, they're basically looking 6 to 12 months out, saying, okay, the Fed is going to be able to harness in this inflation. Balance sheets at these corporations are better than they've ever been.
Absolutely. Yep.
So the blue sky on the horizon.
Yeah. So I referenced this chart, how if you would have held this aggregate bond index, this is the Bloomberg Global Aggregate Index, where, again, if you would have held this on January 1st, you have to remember that when bonds are yielding zero, you're buying a bond at a certain price. The yield is what it is. Is what it is. As yields go higher, bond prices move inversely lower. So anybody that was long bonds beginning of the year has been taken to the woodshed as far as bond prices have taken a big beating here to give these higher yields. But now, as you kind of look at kind of what's yielding today, like we always talk about the 10-year, that's over 4%. 2-year, 1-year treasuries are yielding 4.5%. So you can see as a result of this how you've got this massive cash outflow of equities now, and you've kind of reversed course, and you're seeing all this money flow into treasuries, where, again, return of income, return of investment at a some kind of return greater than zero seems to be a better alternative than sitting in equities and trying to play the ups and downs of the market here. So, you can see, again, where money is flowing, and we'll see if this kind of reverses with equities breaking out here. Do you get some Q3 type money flowing back into equities? But this is a telltale sign of don't trust this rally in equities. If you don't get this to reverse and see new money flow into equities here, then this is stopping people out. When this ends, if their new money is not there, just like lumber, if the new money is not there to support a big move higher, then question it. You need that new blood to fundamentally show that they justify that rally. Without that, this is a supply constraint, your supply driven rally, and at the end of it, if the fundamentals don't mesh up, it's not sustainable. So something to watch with equities. You get into what's going on with commodities. US dollar is continuing to moderate and trend lower. You've got a nice saucer top here, And so you're definitely seeing
But
some
from a
stability.
crazy high level, it's still way the
Yeah,
heck
no,
up
it's
there.
still, looking at the dollar right now, you're just sub 111. So to put that in perspective, I think, we peaked out at about 114. So you're one or two bad days of being back at those highs. And so this is the conundrum the Fed's going to have to face is if equities continue to surge higher, and let's say you get that move in the S&P back to 39 to 4,000, and earnings aren't as bad as the expectations are for Q3, and you get stability in energies and some of these other commodities and begin to trend higher, has the Fed accomplished anything? Have they really, can they honestly say that they've controlled inflation? So be careful what you ask for as far as Fed posturing here, whether they're dovish or hawkish. You want to see asset prices moderate here. The worst thing that can happen is assets take off here going into the end of the year like a Santa Claus rally. That keeps all the pressure on the Fed to prove that they have inflation under control.
Well, and the Fed will just sit there and tell you that they look at the data that comes through. So they're going to be
Yeah,
looking at
yeah.
CPI and the core PCE.
Yeah, no, absolutely. Absolutely. So you look at the last 5 days, gasoline is back up. Here's NASDAQ, crude oil, Dow. Here's actually, this is Brent crude, European crude. This is our New York, I'm sorry, Texas crude. And then you see the S&P here. So you've had a nice bounce back, basically in energies and in equities. And then you look at the losers over the last 5 days. And lumber, even with that kind of rally we had Thursday into Friday, like I said, has given it all back, and you're still down, net down over the last 5 days in lumber. And then you can see the VIX has kind of fallen victim here to equity surging back to the upside. And then bond prices, you're still, when you look at, 10-year treasury, you're still up over 4%, still trending higher here. And when you look at the 30-year, again, looking at kind of a $300,000 loan, and I'll kind of show you why I moved this down, 10% down. You're still up well over the 7.25 plus area as far as 30-year mortgage rates are concerned. And so big picture, and again, this is from Leonard Kiefer, Fannie Mae, and Freddie Mac. Mortgage rates in 2022 post its fastest increase in over 50 years. So, you're even the high watermark of 1982, you've exceeded that. And so when you look at, I think this is a great visual chart, Mike. A year ago, at 3.4%, you could buy a $400,000 home. With interest rates floating up to 7% now, that same affordability rate has dropped to 274K. So that's why, okay, this is what people can afford now. At these interest rates, that $400,000 home is sub $3,000 right now. That's, again, not my opinion. This is from John Burns, courtesy of Freddie Mac, Fannie Mae. This is the reality of what we've seen happen when interest rates increase at the highest pace in 50 years. This is the reality of what exists today for housing.
That is a pretty wild chart, man.
Yeah, no, it just, I think, again, I love charts and graphs because visually they just put it into perspective. And so, okay, rates don't moderate at 7%. They go to 7.5%. Does this drop to 250? How many homes are available for $250,000? This kind of explains why when you look at existing home sales, you look at supply of homes on the market, but there's no growth in those because those homes don't exist. You're going to sell your house. Well, where are you going? And so, so I know, a negative tone with housing, but to put this into perspective, here's U.S. housing starts dropped 8% on a seasonally adjusted basis in September. Despite the drop, year-to-date cumulative starts through September are the most since 2006. So we know that we're trending down, but the reality in the grand scheme of things is we still have extremely good housing starts. I know we're shifting from single back to multi, but aggregate starts at these levels are still, historically speaking, pretty good numbers here. Look at the, we want to compare current time frame to 2007, 2008, 2009. You can't. It's an apples to oranges comparison. And so, housing starts through September most since 2006. This is another way of visually seeing this. You still have good housing starts numbers.
Yeah.
And then this is one of my favorite charts with this slide deck. We've talked about single family giving it up, multifamily taking from single, and you see, you've had this wide disparity. Now you're finally starting to see the convergence where, is it possible that you see single family drop under multifamily, over the next quarter into Q1 of next year? And as much as I don't think it's possible, you're certainly still seeing a significant narrowing between the two. And again, what does this mean? Well, we know that multi uses significantly less wood than single family. So there's significantly less demand. If we're shifting to that multifamily component of demand, there's significantly less demand with softwood lumber. Another great visual chart. This is single family homes issued. This is your building permits on a single family basis nationally. Obviously the warmer the color is organic growth. Blue is not a good color. So you can see how the single family component has pretty much been annihilated. Like California, obviously a hot market. North Carolina is still a good market. Is anybody moving to West Virginia?
New
Anybody
Mexico.
moving to Missouri
what an outlier.
here? Yeah. So I'm not, going to put a lot of credence into some of these outlier states right now. And I have nothing, against, but these aren't your big, your population is not gravitating toward these positive states here. Obviously North Carolina, yeah, California, maybe, depending on politically what you see there. And so the flip side of this is look at the multifamily. So again, as you take from the single family component, the multifamily steals the thunder here. And look at some of these multifamily growth metrics year over year. Look at Nebraska, look at Oklahoma, even Texas, 22%, Georgia, 195%.
Hawaii, 222%.
Yeah. No, it's pretty amazing to see some of these net changes where even places like, people want to live, obviously, when it comes to starts, the Carolinas, Florida, Texas, those are your big areas of growth. And yeah, they're still growing, but it's all multifamily now. So here's existing U.S. existing home sales, and again, existing homes on the market. You're at your lowest growth metric now since 2014, but in the grand scheme of things, it's still pretty decent. We haven't gone back to the capitulation years 2009, 2008, 2007. And so jumping into lumber.
Lumber.
Yeah, so on a continuation chart, we're trying to get this breakout to the upside here. Broke out of this bear flag formation finally. When you look at it, here's the just kind of slightly different kind of way of looking at it. You've had this coil formation we've chopped around, and you're trying to break out, but break out to do what? And we'll get into it.
Oh, we lost
Did
you.
I cut up?
You're bouncing in and out.
Okay, am I back?
Yes.
Yeah, I don't know what. Yeah, I don't know why that does it, but so when you look at trying to break out here, break out to do what? The issue, when you look at here's a November a week ago, we were in the 516-ish type area, 520 area. In the past week, we've seen November spike up into this call it a 550-ish type area. So you had a 50% retracement. We got close to 62%, but not quite. You traded up into the 100-day. So this black line is the 100-day moving average. So you had the first attempt into the 100-day, and you've since failed. You've been kind of in this channel formation higher, broke down under the 9-day, which is in the 515 area, second day under the 9-day. So at the very least, this is the same chart. 50, 62% retracement back to the downside now is a 477 to 460 area. If the market is truly trying to bottom here in both cash and futures, then the reality is we should hold the 50, 62% retracement in both November and January. You can make the case that November, at a 62% retracement, you're well under print. Print tonight is my guess is going to be probably a 480-ish, 475 unchanged to 480. So to people perceive value in the November. And then the one thing I'll add on this rally to the upside and the failure so far, again, you failed into that 50, 62% retracement to the upside. When we look at, and I'm going to fast forward here, we'll come back to this, Mike. I'm going to go to open interest. A week ago, open interest was 2605. We know at the high water mark, we topped out at about 3,000. Since then, open interest is now down 24.5%. So obviously this is a short covering rally.
Yeah, we're not seeing the bottom of that.
Yeah, but sorry. Let me, I probably cut it out. Hang on one second.
Okay, no worries.
Let me, I'll pull it in from the CME here. All right, let me blow that up. So here's open interest today, 2340 down 5. So again, open interest has decreased by about 25% since the high water mark. Obviously, a huge component of this liquidation. A huge component of this liquidation. Am I back up, Mike? Can you see it? There you go. Yep. CFTC. So obviously, managed money has been a huge part of this liquidation. Managed money from their high water mark is off about 33% now. And again, this is as of last Tuesday. So this doesn't even include the rally we had Thursday into Friday. So the reality is the funds have probably liquidated 40% of their net short position. You've had late long fund adding here. And so as the funds come out, they're finally starting to get replaced by commercial shorts. And then you've also had on this rally to the upside, longs taking money out of futures and just going to buy the physical cash. Cash is really, you've had November go from a 450, 460 area upwards of the 550 area, where cash at the low water mark has really bottomed in that 440, 445 back to a 475 area. So you've had a substantial move in futures. This has been a great opportunity for forward longs to take their money out of futures. And so from a basis standpoint, let me see here. So here's a week ago, we talked about that basis being extremely wide, where futures is trading $70 over cash. Cash is trading at a $69 discount.
We had not seen that for a long time.
Futures is your best sell. Cash is your best buy. This is on Friday. That basis was $64 based upon print. And you can see with the collapse here in futures the last day or so, you're back down into this $36, and this was as of yesterday's close. This is somewhere around $25 right now. So, again, when I go back to the November chart, and we'll talk about the spread here, but when I look at November, where do you see value in November? Is November a buy? If cash is legitimately a 475 to 480, are you going to incentivize all these new buys to come into November at a premium to cash? The reality is, as you turn the page into the spot month, to attract the buy side, you either need to squeeze in cash, or you need to have November float down to somewhere where people, look, it's obvious I can buy November at a discount to physical cash. to me, this isn't, at $495, technically I can make a case that I'm going to buy this 62% retracement. But when I look at futures versus cash, there's really nothing obvious with November here right now. And
Yeah.
again, that's just my opinion.
Well, and November is also pretty long in the tooth. I mean,
yeah,
not a lot of time left. It really, we really need to start switching our gaze over to that January contract.
Yeah, and so here, you've had November. We talked about this, again, timing versus price. A week ago, this spread was still out in the 12 to 15 over area. Since then, you gave this massive reversal here. You broke down through, this is a bear flag. You collapsed down through here. At one point, this spread traded, I think it traded 440 under yesterday. It's traded 330 under today. So again, timing versus price. As the commodity funds got pushed out of their positions here, the idea that this spread can continue to widen out going into month end became less and less likely, because you just didn't have all those commodity funds. Instead of rolling, they were liquidating. So now this spread back at even money. Well, again, how much do you believe in November? Do you want to buy November? The reality is you've probably shifted gears into January, where if it's wrong and there's more float back to the downside, at least I have the time to kind of own the January or March versus November. The reality is you're either speculating on November, which is fine, you're trading off of technicals, or you own November and you're looking to EFP them, where you didn't come out on this rally because you're going to ultimately EFP with, the two big mills that EFP and Western SPF. And so here's Jan, March, still trading at we've rallied, but this Jan March structure is still negative 770 under. So again, January and March probably represent better buy opportunities now that we're this close to the spot month. I'd rather put my stake in the ground in these back months because I have the time. And so from a forward curve standpoint, you've had that Nov-Jan spread collapse in. And even this January, March, I mean, this is traded into on Friday. This traded into the $4.50, $5 area. So it makes a lot more sense where I'm not really paying this much in the grand scheme of things. You're not paying a dramatic cost of carry to own further out on this curve. So it's okay to buy these back months.
Right. Then less cumbersome moving your position over when the time.
Yeah, absolutely. And so again, basis, here's January. Again, 38 under. Cash is still trading, or January's trading 38 over. Cash 38. January is trading $38-$40 over relative to cash. March, kind of the same thing. You're in that 40 area right now. March is actually down $17 today. January is down 17 today. So on these pullbacks in these back months, that's where I'd want to do my accumulating. As far as, should I be buying cash today? If you need it. If I'm going to accumulate anything, I want to do it in futures because I don't have that 100% cash outlay, and the cost to carry isn't that much where I can buy, with print legitimately a 475, 480. You can buy January at $491 right now. You can buy March for $504. That's not a lot of cost to carry to pay for to own wood for the time frame when you're actually going to consume that wood.
So, can you jump back just to the Jan outright contract?
Yep.
I mean, we have.
Let me. I'll pull. I don't have a Jan. I'll pull in a Jan here.
It really ended up being kind of the classic buy the rumor, sell the fact. There were some significant curtailment announcements.
Yeah.
That have come out.
And so, I mean, Interfor obviously had theirs late last week. Here's January. No, absolutely. This is your buy the rumor right here. And then the reality is sell the fact. And again, these are all necessary things that have to be done. I will give Interfor credit where think it amounts to a decent chunk of production, and they did said it's spread across all regions, so they didn't specify. It's not all Western SPF. I guess the way you would interpret that is it's Western SPF, Eastern SPF, potentially Southern Yellow Pine, and the way that they're going to do it is just it's going to coincide with shutdowns, holiday shutdowns, seasonal shutdowns around U.S. Thanksgiving into Christmas, where to kind of take that production off the market. You're going to take an extra day before your anticipated shutdown, maybe an extra day after, and then aggregately that adds up to whatever their production numbers are. And then the other big one that came out I saw last night on Castanet was Gorman Brothers in BC was laying off I think they employ somewhere around 300 employees. They were going to lay off 7+ employees, and the writing on the wall with that one is just lack of logs slowing their production down because they just don't have that log.
I'm sorry, who was that?
Gorman.
Oh, Gorman Brothers. Okay.
Yeah, they do a lot of high demand boards. It's a good product. They've got a pretty consistent customer base because they put out good stuff.
So I'm sitting here looking at this, going, all right, we just had all this supply curtailment, and we had what amounted to a nice rally. Nothing. It wasn't screaming off the charts. And then we come into this week and it just gets clobbered.
Yeah, no. And so Mike, this goes back to your classic bear market supply constraint rally where you can get these big spikes to the upside. Seasonality, we know we're supposed to bottom this time of the year. But when you go back to the CFTC numbers here, so when you look at the CFTC numbers, we know that the funds have been short. The industry never got short this market. So again, this is your cannon fodder. This is who you stop out with these supply constraint rallies. Yep. But at the end of this, the industry's not short. So you run out of people to stop out. And if anything, the higher the market goes, this number gets smaller. This number, the hope is you hope this market up because this number wants to get bigger.
I mean, I'm not really hoping for this, but I think we're going to see a very choppy market. I think shorts get squeezed, and then a bunch of enthusiasm into the market, and then the cash longs get beat up.
Yeah, and so the other reminder is that both Fraser and Canfor have their earnings out later this week. So it'll be interesting to see those earnings and listening to the conference calls as kind of the state of the economy for sawmills in general, what they see going into, not only the end of this year, but into Q1, kind of what does life look like? And that'll be a good listen to, a good read. And right, again, I'll say this again, today's price levels probably have less to do with curtailments because of the origination. Dramatically, all those price curtailments are coming in BC. You'll know it has something more to do with cost of production when you start to see it spill out into other provinces and into the U.S. When you start to get into your high EBITDA regions like Southern Yellow Pine, when Pacific Northwest. The other part of this is Weyerhaeuser, the unions are taking a vote. Their unions are telling the workers to accept the deal. That's supposed to be, I think, we'll know something publicly by the end of this week, where I've heard that they could be up and operational by Monday, Tuesday of next week. And, the numbers I've heard is upwards of a third of their overall production has been taken out with this ongoing strike. So it'll be interesting to see how quickly Weyerhaeuser can kind of get the ball rolling again and get back operationally. But that is we should know something more by the end of this week, and conceivably they'll be back up and operational by early next week.
These curtailment announcements were now through the end of the year. So the next shoe to drop will be, okay, are they going to extend them? Are they going to increase them?
Yeah.
What we do know is if they come back on the market with as much supply as they previously had, the demand isn't there for it. So
Yeah, no, absolutely. And I think Fraser's one that is all telling in their earnings slide decks. You know, they might not publicly announce something, but they'll put it in their slide deck, their quarterly earnings. They might hint or allude to kind of shutdowns for their, you know, going into Q1 of next year. So I definitely would recommend everybody listens, you know, pretty much all the earnings announcements, but you really want to listen to Canfor and Fraser's because there's a lot of great information in the slide decks they put out and in their earnings calls. So I, you know, and those are this week. So I think we should glean some kind of nuggets of information on what lies ahead for Q1 and kind of how C-suite sees the state of their economy, so to speak, going into Q1 of next year.
and I've heard multiple sources now, the European wood at below 500 FOB the port that's going to shut things off. So I think that
Yeah, I mean that's gonna, you
Euro
know,
guys.
for me with Euro, and again, I've asked this of all the Euro mills, my Euro mills that I talk to, you know, how much does FX influence their thought process when you've got this kind of FX swing year over year in Euro and in the British pound versus what the returns conceivably are in the States? How much does that influence the decision making where, you know, the reality is Europe's a lot closer on the precipice, if already not in, a lot closer to a harsh recession. So from a demand standpoint, you know, the FX that has to seemingly should be a gift in coming to the North American markets versus staying in Europe. So I'm all ears there if anybody has any information that they want to share as far as what they see coming out of Europe for the remainder of this year and into Q1.
Well, we are the shiniest penny right now, and if you take a look at what the forward curve looks like with the current interest or current exchange rate, the Euro guys will not slow down. They will keep coming here. But,
yeah, and then the last thing I'll share, Mike, this is, I don't know,
Oh.
relevant as much as I thought this was interesting just to look at. So when you see a log, you know, this is how the sawmills see that same log as far as what can we produce with the minimal amount of waste here. I thought this was a great graphic to look at as far as what you get, you know, depending on the log diameter, how they see it when they run it through.
yes, well, look, every sawmill out there has an optimizer now, so they are going to, you know, get the best yield out of that log possible. All right, excellent. Hey, we got her done in under 45 this week.
Yeah.
Next week we will be No Limit November. So we'll see everybody November 1st, All Saints Day.
Yeah.
And you know, hope everyone makes it through Halloween. But yeah, with that, thanks a lot for tuning in, and we'll talk to you next week. Greg,
Thanks a lot, everybody.
Hang on, Greg. Okay.